You wouldn't know it from listening to the talking heads on TV, but the markets and the economy are doing just fine, thank you very much. The question is, will it continue? And that's the subject of this week's Fastest 4 Minutes in Finance. Hello, I'm John Shrewsbury, in for Scott Inman, who's on special assignment this week for GenWealth. So far this year, the S&P 500 has logged a low double-digit return in the 15% range at the start of the week. But apparently, a good number of people have missed out on what has been a strong bounce back after being convinced by just about everyone who pontificates about such things that the economy was going off a cliff. I wish I had $1 for every number of times I've heard that some market pundits say that we're absolutely convinced that we're headed for a recession. But those forecasts simply did not hold water, even in the face of a determined march to higher interest rates by the Federal Reserve Board. And from all indications, the markets look to be headed even higher as we turn the corner toward the second half of the year. Here are a few indicators that lead us to believe that the markets will still have strength in 2023. First, let's talk about the pause. With the Fed skipping an opportunity to raise interest rates again and inflation numbers falling back toward reasonable levels, the market is hearing that there will be fewer increases in rates in the future and prices are coming under control. Both of those are good for business and good for stocks. The hope is that the Fed has found the right balance to cool inflation without throwing cold water on consumer spending. Second, the market runs on momentum. Anytime there is a new 52-week high that comes after a 52-week low, and both of those things happened in June and back in October, the S&P has always been higher 1 year later. If history's any indicator, there's a chance that almost certainly we will have higher prices on the S&P in 2024 than it is today. We will see if history repeats itself again. Finally, a lot of technical indicators about the markets are showing some positive trends. More and more stocks seem to be participating in the rally that we've seen over the last few months. And a truism of investing is that a broader participation among stocks often leads to higher prices. Now, to be fair, there's still risk out there. Virtually anything can happen these days on the geopolitical front, and there are still questions remaining as to how well the financial institutions can handle higher interest rates and the pressure that those rates have put on the value of their fixed income portfolios. As we have seen this week, the market is not on a relentless march toward all-time highs. That's why any reasonable investor has to have a long-term view when you put money to work in equities. And they must understand that everything that comes from the mouths of market pundits should be taken with a grain of salt unless it's backed up by meaningful data. We thank you for being with us on the Fastest 4 Minutes in Finance. Remember, if you've got questions, just leave us a voicemail or a text at 501-381-5228. And remember, a GenWealth advisor is always available and ready to help you discover, protect, and share true financial independence.